All right, I guess we are. All right, so just a little bit about me real quick. Sorry about that, guys. AlphaShark.com 5 years ago. I've been writing there all the time. Go back and see what I was writing when I was writing it. I think it's great. I founded Eagle Bay Capital 3 years ago, really for the purpose of managing money as one portfolio. That's really the idea. We can get into that later on. If you have any questions on managed assets, feel free to email me at info@eaglebaycapital.com. Like Andrew said earlier, on Twitter and on StockTwits, AlphaShark.com. And when Yahoo Finance started their contributor network, I was fortunate enough to get invited to be on that, and you can find all my stuff on the Tumblr at Yahoo. So, all right, let's rock and roll. We'll go over, I have a discount package for all of you guys later on, where if you guys are looking for research, anything like that, we sell our research to subscribers, and that can be found at eaglebaysolutions.com, and we have a huge discounted promotion that I'll tell you guys at the end. So let's rock and roll. For my attorneys, nothing that you guys see here is any sort of recommendation. This isn't any sort of solicitation. Anything you see here, before you make any sort of trading decisions, please, ask your financial advisor, make sure you're suitable. This is for only educational purposes and for informational purposes and for comedic purposes as well. If you find some of my stuff funny, I certainly do. All right. So technical analysis, right? So I'm a technician. I don't care about the news. I don't care about the fundamentals. I don't care about reasons why. What we study is the behavior of the market, and we study market participants. Stocks go up if there are more buyers than sellers. That's the bottom line. And they go down if there are more sellers than buyers. The reasons why, the stories, I'm not going to be Mother Goose that's going to, sit here telling you stories. That's not what I'm here to do. I am only here to analyze what the market is doing and what the participants of the market, what they're doing. Collectively, if Microsoft closes to 30, the entire world collectively has taken all of the known information and has chosen and has decided that Microsoft is worth 30 bucks. That's what I'm most interested in, is what the market thinks, not anybody else. So the questions that we're asking, we don't care why. Why, if you watch, I don't have cable television, so I don't watch financial TV, but many years ago I did, and I would always see that all day long, people are just questioning why. Why is biotech down? Why is the S&P 500 up? Why is oil down? Who cares why? Throughout the entire history of the market, no one ever has made one penny by knowing the reason why. The questions we want to ask are what and when and how and for how long. Those are the things we want to know. Why is completely irrelevant. We do not care why. We don't have time for that. We're looking for what and when. Those are the things we want to look at. So here's Technical Analysis 101. Support and resistance. This is supply and demand at its finest. This is the most important concept. If you get nothing else out of this entire webinar, this is the most important thing. Support and resistance. This is supply and demand 101. So the blue line represents price, and the red line represents support and resistance. So as you can see, at this level, you have former support. So prices are bouncing off this level. I don't know if you guys can see this, if you guys can see my mouse, but prices are bouncing off of support, prices bouncing off of support, and then once that support is broken, right, up until then, there were more buyers than sellers. At this particular price, demand exceeded supply. But once that level is broken, the market is proving to us that there are now more sellers than buyers. Supply now exceeds demand, and that's what happens when support is broken. So once that level is broken and we know that now supply exceeds demand, now we know that on any bounce back, we know from previous experiences that supply exceeds demand. There are more sellers than buyers at this level, and that's why support, former support, into resistance. This is what we call polarity. This is the most important concept that we're going to talk about this entire time. Polarity. Former support turns into resistance, and it works both ways. Former resistance also turns into support. So At this level, at this price level, let's call it 30 bucks, prices sell off. Prices rally back up, sells off. Prices rally back up, sells off. We know at this point there are more sellers than buyers. We know that because the market is proving that to us. But once that level is exceeded and we break out, if you will, above resistance on any retest of that level, we know from prior experiences that we've broken through this, there are now more buyers than sellers. So on any retest of this level, there are more buyers than sellers, and that's why prices rally. So again, former resistance turns into support, just like former support turns into resistance, former resistance turns into support. Again, that's polarity, and that's supply and demand 101. This is the most important concept that we're going to talk about this entire time. If you take nothing else, this is the most important thing. So let's get right into it. Here's the S&P 500. You want to talk about former support turning into resistance. Here, support broke, right? And even all of the support around 1980, 1975, 1990, a little into 2000, all of that support is now resistance. That's why the market has so much trouble getting above this level. This is a current chart right now. That former support is now resistance. This is what we call overhead supply. This is a very important concept. I've been writing about this for 6 weeks or so, ever since the market originally broke down. And, you know, people were talking about China or Greece or interest rates and, you know, the quote-unquote why that we consider to be irrelevant. The reality of the matter is there's overhead supply. Where there was former support, there is now resistance. That's the reason the market can't go higher. So here's a long-term chart of the S&P 500, and this is a very important concept that we talk about. This is Fibonacci, and I'm going to get into it in a second. You know, the entire 2007-2009 decline, the 161.8% Fibonacci extension of that is exactly where the market stopped going up. You know, the market literally just stopped going up at that level. The market respects these levels, so we do as well. There's a reason I've been posting this chart. A lot of you guys probably follow me on Twitter and on the blog and on StockTwits, and you can see I've been writing about this particular chart since the beginning of the year. That, you know, it gave me anxiety coming into the year that we're approaching this level, and sure enough, the market has respected it. This is the 161.8% Fibonacci extension of the entire 2007-2009 decline. And you guys can look it up, and if you have any questions, feel free to reach out to me. But Fibonacci is seen all over the place. In architecture, you see it in nature, our human bodies. It's all over the place. The Fibonacci sequence is unbelievable. The more you look into it and the more you read about it, the more amazing it is. And when you look at a chart like this, you know, I could sit here all day. I can do an entire webinar on Fibonacci and show you 1,000 times how the market literally just stops at these Fibonacci extensions. It's unbelievable. All right, so getting back to overhead supply, look at all of that churning that took place over the last year. When that consolidation resolved to the downside, all of that former support now becomes overhead supply. So those are the please just get me back to break even crowd that are just sitting there waiting to sell to you. They didn't sell when they had the opportunity. They didn't see this chart. And they're just literally sitting there waiting to sell to you on any rallies back. So all of that overhead supply is a problem. And I think going forward, there are two ways that the market could get better. Number one, we could just continue to correct and the market could get slaughtered, and, you know, that's just the way it is. Or we can consolidate through time and sit here for the next several months and break out at some point in January in the first quarter and get back above that level. But all of that overhead supply needs to be absorbed by the market, and best case scenario, it's going to take time. You can see the same thing in the Dow Jones Industrial Average. Look at this. You have all of that overhead supply. They're just waiting to sell to you. The market isn't just going to rip through that level like it's not there and start making all-time highs and start getting to 19,000, 20,000. It's just not going to happen. So one of two ways. The market's either going to get slaughtered or it's going to sit here for a while and absorb all of that overhead supply. Either way, we don't want to be buying dips. We want to be sellers of rips. And when I talk about, and I think this is an important concept that I'm going to, before we continue, my time frame is not the same as all of your time frames, and that needs to be defined. You know, some people are day traders, and that's what they do, and they're in cash at the end of the day. And some are long-term investors that are going to sit there and own ExxonMobil for years. You know, I'm more of an intermediate guy, so I look out weeks and months, not hours and days. So when I say that we want to be sellers of rips, I don't want to be selling strength on Monday afternoon or Monday morning. You know, I want to be selling anything where we start approaching that overhead supply. Like last week, for example, we got a nice rally for a month where we started making new highs, but that overhead supply came into play. So that's the sort of strength that I want to that I want to sell into. Again, we're looking out weeks and months, not hours and days. So everybody listening to this right now needs to define what their time horizon is. How far out are you looking? What are your goals? You know, what are your risk parameters? What is your time horizon? All of these things need to be defined before you know, before you get going. So here's the NASDAQ 100, and again, overhead supply. All of that trending that took place over the last year, all of that support that broke now becomes resistance. That's a problem. So what I want to point out here is this failed breakout here that took place in July and August. Look at that. You had a failed breakout, and then prices got slaughtered. That's a problem. So until we can resolve this through time, we're arguably not going to go higher anytime soon. So the concept that I want to bring up right now is that from failed moves come fast moves in the opposite direction. A guy by the name of Brian Shannon taught me that many years ago. AlphaTrends.net, friend of mine, super smart guy, taught me a lot. And this is a super important concept because what happens is that you have all of this overhead supply, you have all of this resistance, and then the market breaks out. So you either have short sellers that got stopped out that now have to cover their shorts, or you have the people that, quote unquote, are waiting to buy a breakout and buy it way too late. So after a couple of weeks or a month, the market starts to break down, and all of these buyers get caught. Either the shorts that had to cover their short that are no longer short, or the new longs that are now losing money and have to sell in order to close out the trade. So what happens is all of those former buyers now become sellers simultaneously. All of the buyers that bought the breakout now are like, oh my God, we're losing money, we have to sell. And all of the short sellers that got stopped out are like, oh my God, we're not short anymore, we got to short. And that's why from failed moves, you get fast moves in the opposite direction. And I want to show you guys conceptually how this works. Here you have overhead supply, you have very clear resistance, 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 breakout. And then what happens is, slowly but surely, you start getting back below that level. All of the buyers that bought the breakout are now caught, and they're wrong, and they have to sell to get out of that trade. All of the short sellers that got stopped out need to close out that trade and have to, a short seller that got stopped out need to re-short the stock. So you have all of these sellers. And then come in the momentum players like myself or a lot of the people on these webinars that you've been listening to that see this, and then they bring in, which brings in more sellers from the short sellers that were no longer short, and more sellers from the longs that bought too late and now have to unwind that trade. So from failed moves come fast moves. This is a very important concept, and we're going to talk about this throughout the rest of the webinar. It works in both ways. You also get a breakdown, right? So when you're looking at former support, right, buyers overwhelm the sellers, buyers overwhelm the sellers, buyers overwhelm the sellers, and the textbook tells you to short the breakdown. But what happens is that anybody long this stock has their stop loss below the support level, and if the prices break, they get stopped out, and all of those stop losses get triggered. Simultaneously, you have the short sellers that are waiting for a breakdown in order to get short. So you have a lot of sellers at this level. What happens? A couple days, a couple weeks later, you start creeping back above that level. Well, unfortunately, all of the sellers, anybody who sold, whether they were longs getting stopped out or whether there were new shorts getting initiated, now have to cover their trade and buy it back all simultaneously. And that's how you get a rip. So from failed moves come fast moves in the opposite direction. It works in both ways. And that's what we call a short squeeze. And when we talk about patterns as well, it's not just when it comes to clear support. You know, a lot of people in this webinar, when you talk about technical analysis, you talk about like head and shoulders patterns and things like that. You know, this is a very popular pattern. It's actually one of the worst ever because by definition, markets trend. Markets are trending by nature. So a head and shoulders pattern is a reversal pattern. So to look for head and shoulders patterns, you're essentially doing the opposite of what you should be doing. Instead of looking for trends, you're looking to fight the trend and looking for reversals, which is why head and shoulders patterns very rarely work, and more often than not, just create whipsaws. And so the textbook tells you, you have a left shoulder, you have a head, and you have a right shoulder, and that's called distribution. And once the neckline, if you will, breaks, that's when the trend is over. That's what the textbook tells you. But in reality, what happens is head and shoulders patterns tend to be continuation in nature, and you get that failed breakdown and then the rally. So very similar to what we were just talking about, the oops, if you will. You break the neckline, you hang out there for a few days, a few weeks, and then you rip. So I think the best example of this is in the summer of 2010. Look at the S&P 500 in the summer of 2010. This is exactly what happened. And then the media gets all excited about it because they have something to talk about and they think they're a technician now all of a sudden. I remember specifically Sue Herrera, not to pick on her, she's a great lady, but I do remember her specifically in the summer of 2010 talking about how the S&P 500 was in a very clear head and shoulders pattern that broke. Sure enough, I think the market bottomed that day and started ripping ever since. This is exactly what happened. The quote-unquote head and shoulders patterns broke the neckline, hung out there for a few days or a week, and then started ripping higher, and the rest of they say is history. So once the media starts catching on to a particular pattern, in all likelihood it's too late because they're not technicians, they're journalists. With all respect to them, that's not what they do. So again, just getting back to this previous chart, from failed moves come fast moves in the opposite direction. I think the NASDAQ 100 this summer was a great example. So let's get into momentum real quick. Momentum, I use a 14-period RSI. When I say period, I don't care whether I'm looking at a daily chart or a weekly chart. Those are my time frames, by the way. I'm not looking at intraday charts. I look at daily charts and I look at weekly charts. So when I say 14 period, I'm either looking at, if I'm looking at a daily chart, it's 14 days. If I'm looking at a weekly chart, it's 14 weeks. And you can change the periods. A lot of the software you can change what it is that you could change the time period to 19 days or 13 days or whatever it is. I use a very standard 14-period RSI, and I use it in a very simple way. When markets are in an uptrend, in rallies, they tend to get overbought. During sell-offs, they fail to get oversold. RSI generally uses 70 as overbought and 30 as oversold. So when markets get above 70 and are staying above 70, and on rallies get and stay above 70 and don't get below 30, in other words, they don't get oversold, that is characteristic of an uptrend. That is very bullish. That's a good thing. In downtrends, in bear markets, in bear trends, if you will, during rallies, the market fails to get overbought and constantly gets oversold during sell-offs. So when you look at RSI, you can see the characteristics of momentum, and it'll tell you, or it'll confirm or disprove whether you think it's in a bull trend or in an uptrend. So when you think something is in an uptrend and you're bullish on something, but momentum and RSI is getting oversold, the market is telling you that you're probably wrong, because strong uptrends, markets don't get oversold. Go back and look at financials in 2008. On any of those counter trend rallies, RSI never got overbought, but constantly got oversold. And then when you look at uptrends, solid uptrends over the last few years, financials are a bad example, but look at something like biotech or healthcare, whatever it is, on rallies they would get overbought. On sell-offs, they never got oversold. Those are very characteristic. So we use momentum for a lot of reasons, but in my opinion, this is one of the most important things to confirm your thesis of whether something's in an uptrend or a downtrend. So here's the Russell 2000. As you can tell, we look at all of the averages. We're looking at large caps before, the S&P 500, the Dow Jones Industrial Average, the NASDAQ 100. Those are all large cap stocks. The Russell 2000 represents small caps. And here you have overhead supply. You have resistance last summer, right around this 121, 122 level. You have resistance again in December. Once that broke, getting back to polarity, that turned into support. It turned into support in March. It turned into support in May, a little more support, and then that broke. So there's a lot of market memory here at this 121 area where there were a lot of shares exchanged hands. So on any rally, there's overhead supply. What was former support is now resistance, right? Getting back to that former, the first concept that we spoke about, polarity. I think the Russell 2000 is a great example because all of this former support that was resistance is resistance at this level. There's a reason why the market sold off last week as it was approaching this level. Sellers at 120, 121, 122 overwhelmed the buyers. It's very clear here. And look at momentum getting oversold. Notice how momentum had not gotten oversold all year and now did on this recent correction. That's a problem. That's characteristics of a downtrend, not an uptrend. So not only do we have overhead supply, momentum is now confirming the fact that we're in a downtrend. This is not good. In all likelihood, we're probably going to head lower. I would be a seller of any and all strength, not just in the large caps, but the small caps as well. So the other way we use momentum is for divergences to confirm the trend. So when a market is trending lower and making lower lows and lower highs, if you will, you want momentum to be making lower lows as well. But when prices make a new low and momentum puts in a higher low, that's what we call a bullish divergence. And when I talk about momentum, I'm talking about a 14-period RSI, just so you know. So I'll use RSI and momentum interchangeably, but what I'm talking about is a 14-period RSI, daily or weekly. So when you have prices making fresh lows and momentum putting in a higher low, that's what we call a bullish divergence. And that is characteristics of a change in trend. Sure enough, this is when prices started rallying. In fact, this is actually a chart of silver in the summer of 2012. So as you can see, prices made a new low, I believe it was July, and momentum put in a higher low, and sure enough, that was characteristic of a change in trend, and prices rallied. It works in both directions. When prices are making higher highs, you want momentum putting in higher highs as well. If momentum puts in a higher high and RSI puts in a lower high, that's a problem. That's characteristic of a change in trend. You don't want to see that. This is what we call a bearish divergence. We actually seen that in a lot of the sectors across the S&P 500, which confirms our overall thesis that we are no longer an uptrend and we want to be sellers of rallies, not buyers of dips. That is an overwhelming theme that we're going to talk about this entire time. If you have any questions, you can either email me at the end, ask Andrew at the end, or you can go to the blog, AlphaShark.com. I've been writing about this extensively over the last 6 weeks since we originally broke support. We want to be sellers of strengths, not buyers of weakness. So I use a 200-period moving average. When I say period, again, daily and weekly. So a 200-day moving average, 200-week moving average, and we use it mostly for trend recognition. If prices are trending higher above a rising 200-day moving average, that's a good thing. If prices are trending lower below a downward sloping 200-day moving average, that's a bad thing. By the way, a lot of stocks, a lot of sectors across the market are trending below 200-day moving averages. Not a good thing. Momentum in a bearish range, not a good thing. Price below overhead supply, not a good thing. So I'm more of a weight of the evidence sort of guy. So I take all of this, all of these characteristics to come up with an overall thesis, and the thesis continues to be we want to be sellers of rips, not buyers of dips. The one thing that I want to stress is when you have prices near a flat 200-period moving average. This is characteristic of a lack of trend. And we have these, and I'll show you guys some examples in a minute. When you have prices near a flat 200-period moving average, it just creates headaches. Breakouts fail to hold, breakdowns fail to hold, you get mean reversions constantly. If you see a flat 200-period moving average and prices anywhere near that, you're asking for a headache. You're asking for trouble. I'm telling you right now. So what we try to do is whenever we have this, whenever we have pricing a flat 200-period moving average, we stay as far away from that as possible. We want nothing to do with it. So getting back to the market, here's all of the S&P sectors relative to the S&P 500 over the past year. Take the consumer cyclicals out of this. A lot of the strength has come from the defensive names, consumer staples, healthcare, utilities. These are the most defensive sectors in the market. We here listening to this webinar, myself for that matter, we don't move markets. I appreciate Andrew talking about how I manage money. I don't manage $100 billion. But the people that do, the mutual fund managers, the big institutions, they're the ones that move the market. And guys, everyone listening to this webinar, myself included, if we're in an XYZ and we no longer want to be in XYZ, we just sell it, see ya, and we're out of it. And it's not a big deal. But for long-only mutual fund managers, which represents a large portion of the overall stock market, you can't just go to cash. In fact, they're not allowed to go to cash. In their mandate, a lot of these have to be 90, 95% exposed to the market at all times. their job. So the way that they get defensive, the way that they hedge, the way that they try to outperform the market is by moving money into the more defensive areas where if the stock market gets slaughtered, these particular sectors and stocks are going to get slaughtered less. In other words, they're going to lose less money on declines. So when you see money flowing into consumer staples, healthcare, utilities, out more so than the overall market or the overall sectors, those are the large institutions that are shifting money into the more defensive sectors. So the market is telling us that there's a problem. So we're looking at financials here relative to the S&P 500. So this is the performance of how financials are doing compared to the overall market. And, we're really in a sideways range here. We're going to see them in a minute, but I just wanted to reiterate the flat 200 period moving average and price right near it. This is not a chart we want to be buying or selling for that matter. This is something we want to stay away from. Financials relative to S&Ps. Here are staples, consumer staples relative to the S&P 500, making new highs. Getting back to what we were just talking about, how the institutions are flowing money into the more defensive areas. So staples relative to the S&P 500, that's a good thing. Momentum's getting overbought. Rising 200-day moving average. Prices making new highs. So staples relative to the S&Ps, we like it. Tech relative to the S&Ps, we like it. Making new highs. Flat 200-day moving average that is now starting to slope up. Making new highs. So tech relative to the overall market, good thing. Consumer discretionaries relative to the S&P 500, absolute beast. All year, prices have not gotten oversold. They continue to get overbought. Rising 200-day moving average. Prices making new highs. This is a very important sector because consumer discretionaries are where, by definition, we spend our discretionary income. We talk about automobiles, retailers, home builders. These are consumer discretionaries, and they're outperforming the S&P 500. That's a good thing. Now, what's not a good thing? Energy getting slaughtered relative to the S&P 500. There's a ratio. Energy compared to the S&Ps, making new lows, momentum getting oversold. We have a potential bullish divergence here, but price is not reacting. You have a downward sloping 200-day moving average. That's a problem. You want to be sellers of strength in energy relative to the S&P. Same thing with materials. You have new lows being made. You have momentum getting oversold, not getting overbought, downward sloping 200-day moving average. These are areas where we want to be selling into strength, not buying dips. And this is a ratio that we want to look at, and we always want to keep in mind. Discretionaries relative to staples. Getting back to how mutual fund managers, long-only managers, if they want to outperform the S&P so they can get their bonuses, and they think that the S&P 500 is going to go higher, they're going to overweight discretionaries over the staples. Consumer discretionaries, again, home builders, retailers, automobiles, where we spend our discretionary income. Staples, on the other hand, things that we're going to be buying regardless of the economic conditions. Toothpaste, beer, Coca-Cola, cigarettes. These are the things that we're going to be buying no matter what. So if the market is going to get slaughtered and mutual fund managers see that, they're going to have larger exposure into areas that are going to do well regardless of economic conditions. Like I said, staples, cigarettes, beer, toothpaste, dishwashing detergent, all that stuff. So this is a very important ratio, and right now we're at a critical level. We're approaching, we're near last year's highs, and we're consolidating in a very theoretically healthy sort of pattern. But I'm afraid that this could potentially be a failed breakout and break down. That would be very bad for the S&P 500, in my opinion, because this ratio tends to lead. Notice here in the end of 2008, this particular ratio bottomed out before the overall market did in March of 2009. I'll show you guys in a minute, but it also peaked well before the overall market did. This peaked at the beginning of 07, put in a lower high towards the end of the year, while the S&P 500 was still making higher highs. So this led the market at the top, led the market at the bottom. So what happens here, I think, is going to be very indicative of where the S&P 500 is going, what's going to happen going forward. Here's the chart I was just talking about. This is an old school chart of mine that I've kept in, hands of discretionaries relative to staples, peaking at the beginning of 07, while the S&P 500 continued to make higher highs, peaked at the end of 07. So this ratio led the long-only mutual fund managers. Think of it like as a cruise ship. A cruise ship just can't just reverse and turn around. It takes time for it to reverse, and that's how the market is. So when you mutual fund managers, the long-only funds, making this reversal of the cruise ship, it's indicative of what the overall market's about to do. And sure enough, it also bottomed in November, while the S&P 500 made one more low into March, and this particular ratio had already bottomed out and started ripping from there. So I think this is a very important ratio that we want to watch. Again, you can look at it XLY versus XLP. All right, so what's going on right now? Biotech is one of my favorite shorts. You want to talk about failed breakouts. I mean, this is everything that we've been talking about in one chart. You have a failed breakout and a breakdown. You have a bearish momentum divergence. You have RSI hitting oversold conditions. You have very clear overhead supply. This was resistance. This was resistance. We broke out, and then we broke down. So this level right here, a lot of shares changed hands. This actually, biotech just did a reverse split, 3-for-1, if I'm not mistaken. So this used to be around 240 or something like that. 260, actually 260 was the level. But right here, this former 240 level, which is now around 80 and change, is overhead supply. We want to be selling into this. This is very, very, very clean resistance. And until the market can prove that it can get above this, we want nothing to do with biotechnology. We want to be selling any rips in biotech, not buying dips. Here's an example, Amgen, and when we talk about approaching the market from a top-down perspective, you know, we look at the overall market. We know we want to be selling rips. You know, we look at individual sectors, in this case, biotech, we want to be selling rips, and then we look at the individual components of that particular sector and see what individual names we want to be shorting. Do we want to short the overall market? Do we want to be shorting an individual sector, or do we want to be shorting the components? It really just depends on the risk-reward proposition. In this case, we had a range, we had a failed breakout right here. I mean, it doesn't get cleaner and more beautiful than that, and now we're breaking below all of this overhead supply that was former support. So until Amgen can prove it can get back into this range, we want to keep shorting any rips into 150. Here's Regeneron. Again, failed breakout. What we want to do here is if prices start to break this level here, this was resistance, support, support, support. If prices start to get back below this level, we want to short Regeneron only below this level. We don't want to be short if prices are above this level because this is support, but in all likelihood from failed moves come fast moves in the opposite direction, and I'm willing to bet that prices are about to get killed. This is not a sector that we want to be buying dips. We want to be shorting this if it breaks below this level. Again, we got oversold. Momentum is confirming our thesis, but again, we want to wait for prices to break down. By the way, getting back to that, all of this stuff we talk about, you know, momentum and sentiment and all of these things, all of that is supplemental to price. Price is the most important thing. Only price pays. You only make money if you sell it higher than you buy it, and not necessarily in that order. But that's it. Price is the most important thing that we're going to talk about. Everything else is only supplemental to price. So it all winds down to that. Everything else we look at is just to help us come up with our thesis. But price is the only thing that matters. I just want to reiterate that. So again, I'm not one of these guys, you know, I'm not like, you know, in hindsight's 2020 and, you know, now that, you know, healthcare and biotech broke down, you know, now we want to be shorting it. All signs 6 weeks ago were telling us that healthcare was due for a collapse. You know, go back to the blog. You can see at the beginning of August, I was talking about how healthcare was due for a collapse, and we're going to go over that real quick. Here's the reason. Our price targets were met in the 261.8% Fibonacci extension of the October decline. It hit that level, right? We had a measured move of this consolidation here towards the end and beginning of the year with 4 points. That 4 points took us to 75 and change. That was our measured move. This is where we wanted to be selling it. On this particular day is where we wanted to be selling it. The fact that prices got above that later on, that's not our problem anymore. Not our problem at all. So once prices broke back below that level, we knew something was wrong. And we didn't want to be long ever since then. Sure, did we miss out on a few points later on? Of course. But again, not our problem. The fact that we started breaking down below that and created, you know, what at the time appeared like a failed breakout. I mean, sure enough, it obviously was. But at the time, it certainly it had all of the characteristics of a failed breakout. Here's a shorter-term chart. Here's a daily chart showing momentum, putting in bearish divergences on the last rally on the failed breakout. Again, this is where we wanted to be selling it and hit our target. But on the failed breakout, momentum didn't even get overbought. It didn't even get overbought on this last breakout. So it had failed breakout literally written all over it, and then it was breaking the uptrend line. I mean, it could not get any cleaner. This was in August. And then we look at it relative to the overall market, it was breaking the uptrend line and a bearish momentum divergence. So again, weight of the evidence was suggesting that we were probably heading lower, not higher in healthcare, and there's something we wanted to be shorting. And then again, here's the price. Here's a weekly chart showing with every new high, momentum was putting in lower highs the entire time. A ton of bearish divergences. This is not something we want to be buying, something we want to be shorting. And then sure enough, prices got absolutely destroyed, which we're happy to see. But going forward, all of that former support is now overhead supply. That's a problem. So great, we were right, prices got slaughtered, terrific. But now going forward, it's a new problem. All of that former support is now resistance. So we want to be selling any strength in healthcare, not buying weakness. It's not an area where we want to be. Let's go into financials. Here's the 61.8% Fibonacci retracement of the entire 2007-2009 collapse. It's not a coincidence that that is exactly where prices stop going up. The market respects these levels. We respect them as well. If you have any questions on Fibonacci, please feel free to reach out to me. I don't know why people, I get hate all the time, hate mail, and the media on multiple occasions. I kid you not. I was about to be on TV, and they tell me just before I go on, hey, by the way, JC, we don't use words like Fibonacci around here. I kid you not. This happened multiple times on multiple TV networks. I don't know why people would choose to ignore them. The market cares. We care as well. Financials, stop. This is XLF. Stop going up exactly at the 61.8% retracement of the entire decline. Here's an uptrend line, broken, momentum, bearish divergence, oversold. This is the XLF, failed breakout. We want to be sellers of any strength. I mean, it does not get any cleaner than financials. We do not want to be long financials. We want to be selling any strength. Here are financials relative to the S&P 500, lower highs, lower lows, relative to the market for the last two and a half years or so. We had a breakout this summer that failed. This is a bad thing from failed moves, from fast moves. Again, more evidence that we want to be sellers of strength in financials, not buyers of dips. And then where do I think we're going? XLF, I think we're probably heading down under 18 bucks. This was resistance in 2010, 2011. The 61.8% Fibonacci retracement of the entire rally from 2011 to this year, and former overhead supply. I think that's where we're headed, and it's also the 38.2% retracement of the entire decline. So I think that's where we're going, in my opinion. So we want to be selling any strength in XLF, and we want to be covering shorts in this area. Getting back to the top-down approach, we want to be shorting financials. Which financials in particular we want to be shorting? We don't want to be shorting the strong ones. We want to be shorting the weak ones. This is Citigroup. We just witnessed one of the greatest bull markets in American history over the last 6 years. And Citigroup is at the same price it was in the summer of 2009. You want to talk about garbage. Stocks don't get worse than this. You know, you talk about a sector that's done so well since then. You talk about a market that's done so well since then. Citigroup didn't get the memo that we're in a raging bull market. It's gone nowhere over the last 6 years. And sure enough, we finally broke out this summer. You had all the cheerleaders getting all excited about Citigroup for some reason. All that was a failed breakout. We broke back below that former overhead supply. We broke the uptrend line. We're going a lot lower in Citigroup. We want to be sellers of any and all strength in Citigroup. Now, talk about the global markets. The U.S. market is just one stock market. Here's an example. This is the correlation coefficient between the S&P 500 and all of the individual sectors. The more green you see on the screen, the more they're correlated, the higher they're correlated. In other words, the more they move together. Obviously, you see a ton of green here because U.S. stocks move together. Now, these are 20 countries compared to one another. There's a lot less green in this screen. You have a lot more orange and gray, meaning that a lot of these countries don't trade with the United States. So if you want a non-correlated portfolio, you want to look outside the U.S., not just in America. You want to look outside of it. So here's the S&P 500. As bad as it is, we're still making new highs relative to emerging markets. So, you know, if you want to be shorting anything, you want to be shorting America, the strongest on earth, or do you want to be shorting some of the weaker areas of the world? I would argue shorting weaker areas of the world is probably better because the S&P 500, as bad as it is and as bad as it looks, and I said a lot of bad things about the U.S. stock market in the last few minutes, emerging markets are a lot worse, as you can see here in this chart. Now, we hit the 61.8% Fibonacci retracement of the entire 2008-2011 rally. This was our initial target. So at this point, I think we're in no man's land. However, all of this overhead supply now, all that former support now becomes overhead supply. We want to be sellers of strength in emerging markets, not buyers of weakness. Here's China, hit the 61.8% Fibonacci retracement of the entire decline. Again, the market respects these levels. I don't know why people purposely choose to ignore them. We literally kissed it in reverse. We had a failed breakout, and now we're below a flat 200-week moving average. This is not something we want to be buying. This is something where we want to be selling into strength. A lot of overhead supply here. Here's a shorter-term chart of China. Here's a daily chart. All of this resistance here, that chart, former resistance. Whoops. Back here. All this former resistance we broke out, that failed. Now momentum's hitting oversold conditions. Notice how on this last rally here, momentum was already reversing bad. We want to be sellers into any strength into this area, 43, 44, flat to downward sloping 200-day moving average, former resistance. We want to be selling any and all strength into that area. Turkey, in my opinion, is one of the cleanest shorts out in the world. This is the 61.8% Fibonacci retracement of the entire 08-2010 rally, and that was support, there was support, and it broke. That's a problem. So we want to be sellers into any strength back into that 41 area, and if you take the 161.8 extension of the most recent rally, this particular rally last year, it takes us to 27 and change. That's our target. This is where we want to be covering shorts. Latin America, one of the worst places on earth by far and away. We had a downtrend channel that broke to the downside. Now we have support in this area from 2005 and again in 2009, and this is where we are right now. However, this was former support that broke. We want to be sellers into any strength back into this area, and in all likelihood, I think we break this support because of the weight of the evidence. Here's Brazil already broke that support, and it's suggesting that Latin America is probably going to break as well. Brazil is one of the most important components of Latin America, and we're already breaking there. Looking at Mexico, another very important component. These are the two biggest in that area. You have failed breakouts up here over that overhead supply. We broke the uptrend line, and that consolidation that took place for many, many months resolved to the downside. All of this former support is now overhead supply, not just from the consolidation, but from the uptrend line that goes back to 2009. I think we're headed back to the 61.8 Fibonacci retracement of the 09-2013 rally, around 42.5. This is where I'd be covering shorts. Here's another emerging market, India. This was one of the best areas in emerging markets, particularly the BRIC nations, by far and away for years. And we had a beautiful consolidation that, in my opinion, I thought we would have probably broken out to the upside, and we were actually waiting for a breakout to get long India, and nope, we broke to the downside. So what happens now? All of this consolidation that took place this last year, all of that support that broke now becomes overhead supply. We want to be selling any and all strength in that area, and tactical shorts can be covering their shorts around a little bit over 17 bucks, which is the 61.8% Fibonacci retracement of the entire 2013 to 2015 rally. So selling into rips up here, covering shorts down here tactically. Those former resistance over here. Europe, I think, is dead money. You want to talk about flat 200-week moving averages. We're right in between this giant range. It's not somewhere we want to be. I'd be selling into strength up here if we get up there, covering shorts down here if we get down here. Right here, we're completely no man's land. You want to talk about headaches, flat 200-week moving averages, headaches. European financials, disaster, failed breakout, flat 200-day moving average. We broke the uptrend line, all of this support, now overhead supply. We want to be selling any all strength up there. A good example is Deutsche Bank, DB, complete disaster. You want to talk about stocks that haven't done anything since 2009. Look at Deutsche Bank. I mean, this literally has done, it's worse than Citigroup. It's hard to find something worse than Citigroup. Deutsche Bank figured out a way to do it. This is a disaster. I would be shorting a breakdown below all of the support. I would only be short below the lows since 2011, 2012. I see no reason to be short if we're above that, but it certainly appears that we're going to be breaking down below that. This is a disaster. Here's Japan. This is hedged DXG. So this is Japan hedged for its currency. You want to talk about, we got back up to 2007 highs, failed breakout just above that, and are absolutely getting slaughtered ever since. From failed moves come fast moves in the opposite direction. There's a ton of overhead supply in this area, which we're nowhere near, but I would be covering shorts right under 42, which was former resistance here, as well as the 61.8% retracement of the entire 2012-2015 rally. And this is one of the most important charts in the world, in my opinion. This is dollar yen. We're right at the level. We're doing the exact same thing that happened in 2007. This is where the Russell microcap index peaked, mid caps, large caps. This is where Treasury bonds peaked, the Dow Industrials, NASDAQ, New York Stock Exchange, all of them peaked at this level. We had a failed breakout at the end of 07, and USD yen got slaughtered. Sure enough, we've seen the exact same thing right now. We had a breakout earlier this year that failed. If you want to know where the S&P 500 is going, you want to know, you want to look at USD yen. Right now, the correlation coefficient is through the roof. It's almost exactly 1. It's as close as I've ever seen it. So there's a direct positive correlation between the S&P 500 and dollar yen as we speak. So here's the chart that I'm talking about. Super high correlation coefficient. All of this former resistance is now overhead supply. You see this? So we have a consolidation here that's taken place since last month. If we resolve to the downside, which in all likelihood we will, the S&P 500 is going to follow. The correlation coefficient between dollar yen and S&Ps are through the roof. This is the most important chart in the world, in my opinion, right now, if you are long the overall stock market. I just wanted to go over a couple of charts. I know we're losing some time, but you know, just getting into sentiment, you know, we want to look at sentiment from a contrarian perspective. Sentiment, for the most part, is just noise and just really a waste. You know, especially it's in the middle. We want to look at sentiment when we're at extremes. Here's the U.S. dollar. I got this from Sentiment Trader, great website. U.S. dollar index was very, very bearish at the time. This is in May of last year. Getting back to this particular chart, when you have a head and shoulders pattern that breaks down, in all likelihood, it's just a continuation pattern, and that's a great opportunity. This is what dollar looked like last May. You had a failed breakdown and a very clear distribution pattern that a lot of people were recognizing. Let's remember that the euro represents almost 60% of the entire dollar index. And this is what the euro looked like. The sentiment in the euro was very, very bullish. Look at this downtrend line. It was very, very bullish at the worst possible time. Here's a closer look at the dollar, at the US dollar index, head and shoulders pattern, breakdown. This is a beautiful entry point right here. I was writing about it. The epic squeezing higher in US dollars just began. This is May of last year. Sure enough, we got an epic rally. This is what it looks like today. This is where we were talking about it to buy it. This is where we are today. We ran to exactly the 161.8% Fibonacci extension of the entire 2009-2011 decline. This is overhead supply. I mean, I don't know why people ignore Fibonacci. The market clearly respects it, so we do as well. Here's a closer look. I think we're in no man's land in the dollar right now. Until we resolve out of this pattern, whether to the upside or to the downside, I don't think there's anything to do in the dollar. Same thing with the euro. Until we get above this, with a downward sloping 200-day moving average, you know, it's a tough buy. I think a little bit more time is necessary for the euro to break out. If it does or breaks down, we'll wait for that resolution to make a decision when the time comes. The one I like right now is yen. I really like it. These are yen futures. This was former support that turned into resistance. We have a bullish momentum divergence. Momentum getting overbought in the most recent rally. I think if we break out to the upside and we break out above the resolution from this particular pattern and the downtrend line from the highs from a year ago, I think we're going a lot higher. Sentiment is very bearish as well. Looking long-term at the yen, here's support going back to 2003. We briefly broke down below that, kissed the 261.8% extension of the most recent rally in 2013, bullish momentum divergence. Man, if we break out, like I was showing you in the shorter term charts, I think we're going a lot higher. I think there's a lot of upside here. So here's the short term look. If we break down in USD yen, which is the yen futures, go up, USD yen is the denominator here. So this breaks down, yen futures look like a major buying opportunity. And finally, the last thing I want to talk about is just treasury bonds. You know, the obsession with higher interest rates. These are interest rates going back, you know, 80 years. And we're in a very clear downtrend in interest rates. I don't know what everyone is so obsessed about interest rates going higher. You want to talk about, you know, looking at the trends. This is a downtrend. I mean, I don't know what the obsession is with interest rates going higher, it can now be more clear that rates. And then looking back at history, I don't know why everyone's such a rush. Historically, bottoms in interest rates take 15, 20 years. Look back at the 1830s. Look back at the turn of the century. Look back after World War II. A bottom in interest rates takes more than a decade. So the obsession with higher interest rates, leave that to the media. As market participants, we're not in any rush. You're going to bet that we're going to have the first V bottom in interest rates in American history? That's what you're trying to bet on? No. I think this is going to be a process. I think it's going to take time. Look at 2-year yields. Look at the breakout that we just saw that failed. From failed moves, come fast moves in the opposite direction. I'd be willing to bet interest rates are going to go a lot lower very soon based on what we're seeing here. And then the one that most people trade is a TLT. I think it's dead money. You have a flat 200-day moving average. You have prices in between this range. I'd stay as far away from this as possible. It's not somewhere we want to be. And then, you guys can reach out to me if you're looking for something, but this is the discount that I wanted to show you guys. I saw my research. There was a lot of demand for that for many years. And finally, we're able to do that last year and start selling the homework that I'm doing anyway. So, you can either get all of the global markets, so it's all of the indexes from around the world, and a full year of all of the U.S. averages, S&Ps, Dow, NASDAQ, all of them for $129 a month. I think it's a great deal. You're essentially getting the U.S. averages for free. So you can go to vip.marketfi.com /JC Parets and get that. And if you miss this or you don't get the link, just email me at info@eaglebaycapital.com. And the other package we're selling is all of the global markets and the S&P sectors, $1,000 for the whole year. I think it's a great deal. It's what I love to do. I look at all these markets all the time. These are huge discounts. I appreciate Andrew, inviting me on here. So I wanted to kind of come up with some kind of, discounted special for you guys. By all means, take advantage of it. And if you don't have time to get this, again, email me at info@eaglebaycapital.com, and I'll make sure to figure something out. But I know we're running out of time here, Andrew. I don't know if you want to take any questions. Anything?
Yeah, hey, sorry about that. Actually, we had a bunch of questions. We can take about 5 or 10 minutes for the questions if there's any specific charts you guys want to look at. Someone wants to look at the GLD. And I'll put the link in here for everybody to make it easier.
How's that? Can you see the chart?
Yeah, it's good. Yeah, it's good.
Perfect.
That's sink or swim?
Yeah.
I put everything in black background. I don't like the white.
I like the white because it's cleaner. All right, so I like my chart is really clean. I use a, you know what? Actually, since we're talking about the GLD, let's go back a little bit further. So the GLD, I think this is where we're headed. I think we're headed to $1,000 in the gold, which represents what, 100 and change in the GLD. This was resistance in 2008. You see this, right? I think that's where we're headed. No doubt about it. I would be fading any strength in GLD. It's one of the worst sectors in the world for sure. One of the worst areas in the world for sure. Looking shorter term, you're below a downward sloping 200-day moving average. I mean, look at all of this former support that is now resistance. I mean, is this where you want to be buying right now? I think there's just a lot of trouble. I think in all likelihood we head lower. Best case scenario, I think we continue to churn sideways here and maybe put in a bottom, but I think that's going to be a process. It's not something we want to be buying. It's something we want to be selling into any strength. I mean, we're trending below all this overhead supply and below a downward sloping 200-day moving average. There's no reason to be buying this. I mean, if you're a day trader or you're in this for a couple of days, that's one thing. But if you have any sort of intermediate term time horizon like myself, there are better places to be for sure.
If you shorted it here, hypothetically speaking, would you leave a stop above the recent highs from what looks like maybe about 15 days ago, or would you put it above the trend line or above the moving average?
A sell stop? Like
stop loss.
On a short?
Yeah. If you shorted it here, hypothetically speaking, would you short it? Would you leave your stop above that recent high in August, above the moving average, or above the trend line? Because a lot of people, one thing they don't do well is putting.
Well, I don't use I don't use moving averages for support and resistance purposes. I use moving averages for trend recognition, and in this case, a downward price below a downward sloping 200-day moving average is just evidence of a downtrend. I don't, moving averages are invisible lines, like they don't actually serve as support and resistance, as you can see in this chart. But I would, first of all, I wouldn't short it right here. Okay. If I was short today, I would have a stop below above Thursday's highs. I wouldn't want to be short about that.
Good, I like that. Okay, how about IBB? Sure.
Well, we just looked at that.
Okay, how about Tesla?
Tesla. Come on, TOS. There we go. Tesla. This is not as bad as it's been recently. Here's how I see Tesla. You got resistance up here. You got resistance here. I like how momentum did not get oversold in the August decline. I think that's a very good thing, actually. But there's overhead supply here. So if you're long, I think there's trouble around this 287, 285 level, which again, depends on your time horizon. If you own it at 256 and you're selling it at 285, an argument can be made that 30 points is a lot of money. For me, I don't see a good risk versus reward proposition. If I was long, hypothetically, I would only be long above these lows right here, 250, 255 and change, if you will. I wouldn't be long below that, and I would be selling into this resistance here. To me, that's the trade right now if I was in it. But I wouldn't be buying this because I think there's a very high likelihood that we get back down here. Again, getting back to a flat 200-day moving average has headache written all over it, not for me.
Okay, cool. How about two more? How about, obviously, everybody's favorites, Apple and Facebook?
Well, Apple I've been writing very extensively about. I think it's one of the most clean charts out there. It was a very easy sell earlier in the year. You can go back on the blog. I know we're running out of time, so I don't want to go back on the blog right here. But if you look back, here, I'll show you real quick. You want to talk about Fibonacci. Andrew, you use a lot of Fibonacci or no?
I do not. I use Ichimoku Cloud, to be honest, for mostly everything.
You want to talk about price targets being hit. Here's the decline from 2012 to 2013. Boom. 161 extension of that. That's where price is reversed. And then if you want to get cuter, you look at the consolidation from the fourth quarter last year. Boom, same level. This is where we wanted to be selling. I was very vocal about it at the time. That's where we wanted to be selling out, but there was no reason to be long. We wanted to buy this breakout. We wanted to sell it into here. We did nothing. And this entire consolidation that took place over a 6-month period, this entire consolidation resolved to the downside. So all of this former support now becomes overhead supply. You can extend this. You want to be sellers into any strength into that area. There's no reason to be long Apple at all, because all of this distribution took place. All of that former support is now overhead supply. This is not something we want to be in. It's something we want to be selling into. Again, best case scenario, we continue to consolidate sideways, maybe get back into this range, and maybe one day next year break out. Fine, but for now, we want to be selling any and all strength. This is not something we want to be buying.
And Facebook, I know that should be on your way.
What are you going to do here, Andrew?
It's got to go to 100. It's got to put 100 print on it.
Dude, it got to
99.40. It's got to put a 100 print on it within the next 6 months. I don't think it holds, but I think it has to put 100 print on it. It's been so strong. Look at that. Talk about higher highs and higher lows in the daily.
Agreed 100% relative to the market. Yes, it's been strong. Totally. I couldn't agree more. Momentum getting oversold last month, that annoys me. For me, it's all about risk-reward propositions, right? So fine, let's say you're looking for 100, you're looking at 7 points. What's your risk? What's your downside? To me, there's way too much downside just to look for 7 points to get back up to this resistance. Where are you wrong? Where do you put your stop? You put your stop down here, 91.80, something like that, with the lows from the last couple of days, fine. But you know, where else are you gonna put your stop? That's my problem with it.
I would rather. I'll play it long on earnings and through the option market though.
I don't care. I don't care where you think it goes. I care more about what's the risk you're willing to take for that. And at this point,
agree.
I just think that the risk isn't well defined. Now, if you're doing it through options and you're buying premiums, the most you can lose is the premium you pay. So that's one thing. But in terms of the common, if you're going to be in the common here, where are you wrong?
Your stop probably under what, 87-ish.
So if your stop's under 87, you think it's going to 100, you're looking for 7 points, and you're willing to risk 6. You're going to risk $6 to make 7. That doesn't make any sense.
I think it depends on your general thesis of the market. If you think 1900 held as we bounce under 1900, I was saying we were going under 1900 and we went to like 1897 on the futures, and then we pop right back. So it's been strong in a weak tape. So if the market reverses and goes higher, obviously we failed on Friday, and Friday was an ugly day to be a bull. You know, if the market starts going higher, I think Facebook's going to outperform.
Well, number one, I don't think that the market's going higher.
I agree.
Number two, Facebook outperforming, I agree with that, but are we looking for, are we mutual fund managers looking to have relative performance, or are we looking to make money with absolute performance?
But it's hard to short up here when you see the strength on a day-to-day basis when it closes higher than the open for 12 or 14 days.
Then don't, and again, getting back to it, is this the one you want to short? You know, do you want to be shorting the strongest stock here, or do you want to be shorting the Caterpillars of the world, or the Turkeys, or some of the other names that we mentioned? You know, just because we're, you know, trying to buy one of the few good names in the market when we're clearly in a downtrend is equivalent to trying to short the bad names in the market when we're in a beautiful uptrend, right? You see what I'm saying? Like, I think you're just barking up the wrong tree. Trying to buy Facebook because it's showing good strength, I think you're better off trying to short the bad names than trying to get cute and buy the few good names. It's the same thing like the last few years, trying to short the bad names when we're in a beautiful tape when you could be buying Netflix or Facebook for that matter in a great tape. You know, I think it's the exact same thing. I think we're in a downtrend. I think we're going lower. And I think trying to get cute and buying one of the few good names where we just created the risk-reward proposition where you're trying to make $7, but you're willing to lose 6. You know, for that, bet on the Cleveland Browns on Sunday. You know, if you're looking for those kind of, you know, if you're looking for that sort of bad risk-reward proposition. bad example of the Cleveland Browns, but you know what I mean.
No, I get it. If you can go back to your sales link one more time, we'll talk about what you're offering today. I put the link in here for you guys in the chat box about 6 or 7 times. So it's https vip.marketfi.com /JC-Parets, and I put the link in, which is easier, so you guys can just copy the link from the answer from what I'm putting in. Is much easier than trying to type it in yourself. So he's got 2 packages he's offering today. The gold package, which looks like it's daily, weekly charts, analysis, global ETFs, 24/7 access to JC, and then we also have the platinum, which gets you a little bit more. What's the difference between gold and platinum, real quick?
So the goal is going to give you all the global markets. It's about 86 charts from all of the indexes around the world, you know, anything from China, Japan, Australia, Egypt, Israel, Germany, France, Ireland, etc., all the Latin American countries as well, Canada, and then you also get all the U.S. averages, you know, S&P, NASDAQ, all that. The platinum package is going to give you all of the global markets I just mentioned, but it's also going to give you the S&P sectors, which includes biotech, gold miners, energy, financials, healthcare, technology, utilities, all of that. You get all of those sectors. It's about 56 charts, and you get those on a weekly basis. And both of them give you 24 access to me. There's a messaging unit that we have where you can just ask questions, and I'm very good at getting back to you within 24 hours. So, you know, if you have any questions on anything that you see or anything, you know, relevant to, you know, to the market overall, you know, you can access me anytime. I think that's a great it's a great part of being a member of our research. And it's something I've always wanted to do, is to sell my research. But Andrew, as you know, easier said than done.
Yeah, but
we were ultimately able to get the technology together to do it, and we got good feedback.